Thank you, Jason. Hi, everyone. Today, I'm going to give you an update on proposed changes to income and estate tax laws. So, Joe Biden announced his American Families Plan on April 28th of this year to build a stronger economy that doesn't leave anyone behind. And the plan is to be substantially funded by tax increases, no surprise there, primarily on wealthy taxpayers. This plan is separate from the Made in America tax plan, which deals with corporate taxes, and we're not going to be discussing that today. Further clarification was made in Biden's Green Book issued on May 28th. This comes from the US Treasury, and we'll be going over the details of this over the next few slides, but just be mindful that considerable changes can still happen in the weeks and months ahead. So under Biden's Green Book proposal, he purports to raise the top individual federal income tax rate from 37% to 39.6%. The top rate would apply to income for individuals at about $453,000 and for married filers at about $509,000. The proposal also taxes long-term capital gains and qualified dividends at ordinary income tax rates for households with AGI over $1 million. So the actual tax rate could be as high as 43.4% once you take into account the Medicare surcharge. And this is almost double the current rate, which is at 23.4%. So a really big change there and not a welcome change. The proposal eliminates deferral of tax on like-kind exchanges of real estate, known as 1031 exchanges, when the gain is greater than $500,000. So for real estate investors who have been able to shield the tax on these transactions, starting in 2022, if this passes, they won't be able to do that anymore. The proposal is silent on the $10,000 cap for state and local tax deductions, what we call the SALT deductions, which were put in place by the Trump administration. And it's also silent, surprisingly, on increases to estate tax rates and decreases to estate and gift tax exemption amounts. The proposal triggers a tax on appreciated property transferred by gift or at death. The assets transferred are treated as a realization event, basically as if they've been sold. It applies to gain above $1 million per person. There are exceptions for property passing to a spouse or charity, for certain tangible personal property, not including collectibles, and for family-owned businesses and small business stock. The existing capital gain exclusion of $250 per person, $500 for married filers, it would apply. So you're looking at a top exemption amount of $2.5 million for married filers. Note that most of these changes will be taken effect after December 31st, 2021, except for the increase in capital gains and dividends rates, which right now would be retroactive to April 28th of this year. There are other tax proposals that are currently in the Senate for review. One of them is the STEP Act by Senator Van Hollen that deals primarily with income tax reform, and for the 99.5% Act by Senator Sanders and White House, which deals on the estate tax side. So looking at the STEP Act first, this is in line in some regards to Biden's proposal. Taxes will be owed on unrealized capital gain on transfers of appreciated property, either by gift or at death. There are exceptions for transfers to spouses and charities. There is a $1 million exemption, just like under Biden's plan for estates. However, there is a departure from Biden's proposal in two really important ways. One is that there's only a $100,000 exemption for lifetime gifts. And the second is that there's a retroactive effective date to basically January 1st, 2021. So this year, so any gifts or transfers made in this year would be subject to the capital gains tax if this were to pass. For the 99.5% Act, this deals again on the estate and gift side, and all changes are effective January 1st, 2022. For estate tax exemption and rates, it looks to decrease the exemption to $3.5 million per person. This is a significant change from the current $11.7 million that each person has under the law. It also looks to increase the rates from the current flat 40% to a gradated rate, 45% for estates between 3.5 and 10 million, with a top rate of 65% for estates of $1 billion or more. On the lifetime gift side, it looks to reduce the exemption for lifetime transfers to $1 million. This is huge because that is currently tied to the state tax exemption. So we'll have the ability to gift $11.7 million today. And if this goes through, that's going to go down to $1 million. It also limits annual exclusion gifts, currently $15,000 per person, to a max of 2 times the annual limit, which would be $30,000 this year, on gifts to some irrevocable trusts like ILETs specifically, which could have an impact on some of our current client estate plans. So what is the bottom line here? Nothing has passed yet, only proposals at this point. Any of the current proposals could come into play at some level. There's also a lot that I didn't discuss. I tried to keep it to the most relevant parts for our client base, but there's certainly a lot more in these proposals. There's a lot of uncertainty, including retroactive dates under some of these proposals. So there really isn't a best planning scenario. However, estate and gift exemptions remain at an all-time high. So that does prevent a real opportunity to do something on the gift and estate planning side. So the key takeaways for today would be that planning is personal to each client, that these are bold proposals that may not go into effect exactly as we see them today. And also we're here as always to discuss any planning strategies, whether on the income or estate tax side with you, and to coordinate with your accountant, attorney, and other advisors as needed.